In the previous video, we learned about the different types of conventional loans, fixed-rate mortgages, and adjustable-rate mortgages. We also discussed the pros and cons of each type and how to choose the best one for your situation. You can see the video at the link provided. Now, we will explore some other types of mortgages that are not conventional loans but are backed by the government or have special features. 1. Federal Housing Administration, FHA loan. It's a type of government-insured loan that is supported by the Federal Housing Administration. It is made to help low to moderate-income borrowers who have lower credit scores or little money for a down payment. FHA loans are usually given by FHA-approved lenders. Here are some of the pros and cons of FHA loan. Pros. 1. Easier to qualify. It has lower down payment and credit score requirements than conventional loans. You can get an FHA loan with a down payment as low as 3.5% and a credit score as low as 580. 2. Low down payment. The minimum down payment for an FHA loan can vary depending on your credit score. If your credit score is 580 or higher, you may qualify for a down payment as low as 3.5%. Borrowers with a credit score below 580 may need to make a larger down payment. Cons. 1. Higher upfront costs. FHA loans require an upfront mortgage insurance premium, MIP, of 1.75% of the loan amount. You also have to pay an annual MIP of 0.85% of the loan amount. 2. Loan limits. FHA loans have loan limits that may restrict your buying power in some areas. The loan limit for an FHA loan in 2023 is $726,200 for most areas and $1,089,300 for high-cost areas. Overall, FHA loans can be a good option for borrowers who have lower credit scores or little money for a down payment. 2. Veteran Affair, VA loan. It's a type of government-backed mortgage that offers many benefits to eligible borrowers, including no down payment, no private mortgage insurance, or PMI, and more lenient credit and income requirements than conventional loans. Here are some of the pros and cons of a VA loan. Pros. 1. No down payment or PMI is required. 2. Lower interest rates than conventional loans. 3. More lenient credit and income requirements. Cons. 1. Must pay a one-time funding fee. 2. Must meet the VA's eligibility and service requirements. 3. Must pay a VA appraisal fee and comply with the VA's minimum property requirements. Overall, VA loans can be a great option for eligible borrowers who are looking for a mortgage with no down payment and no PMI. 3. USDA loans. It's a type of mortgage that is issued or guaranteed by the U.S. Department of Agriculture. Here are some of the pros and cons of USDA loans. Pros. 1. No down payment is required. You can buy a home with $0 down, which is great for buyers who don't have a lot of savings. 2. Competitive interest rates. USDA loans have lower interest rates than other types of loans, which can save you money over time. 3. Relaxed credit requirements. You don't need a high credit score to qualify for a USDA loan. Even if you have some negative marks on your credit report, you might still be eligible. 4. No PMI is required. PMI stands for Private Mortgage Insurance, which is an extra fee that lenders charge when you make a low down payment. USDA loans don't require PMI, which can lower your monthly payments. Cons. 1. Income limits. USDA loans are meant for low-income borrowers, so there are income limits based on your location and household size. If you make too much money, you won't qualify for a USDA loan. 2. Property restrictions. USDA loans are only available for homes in rural areas, as defined by the USDA. You can't use a USDA loan to buy a home in a big city or a suburban area. 3. Occupancy requirements. You have to live in the home that you buy with a USDA loan as your primary residence. You can't use a USDA loan to buy a vacation home or an investment property. 4. USDA program fees. USDA loans have two fees that you have to pay, an upfront guarantee fee and an annual fee. These fees are similar to the FHA mortgage insurance premium, but they are not cancelable. You have to pay them for the life of the loan. Overall, USDA loans are good for people who want to buy or improve a home in a rural area and have a low income. However, you should compare these loans with conventional loans and other options to find the best mortgage for your situation. Thank you for watching. I hope you found it helpful, and please leave a comment below.